I'll be straight with you because that's the deal on this channel. You cannot return a car. There is no return counter at any dealership in America, Honda, or Ford, or Hyundai. It doesn't matter which badge is on the building or how nicely you ask the finance manager, and it doesn't matter how many stars the online reviews gave the sales team either. Once you sign the paperwork and drive off the lot, that sale is final. No cooling off period, no 30-day grace window, no receipt to bring back the way you'd return a jacket that didn't fit. So no, millions of Americans are not literally walking into a showroom and handing the keys back over the counter this year. What's actually happening is bigger than that headline, stranger than that headline, and honestly more revealing about the state of the entire auto industry than a simple return ever could be. Here's what the word returning is actually standing in for. There are 3 separate paths a new car takes when it leaves its original owner earlier than planned, and this year, all 3 of them are running hotter than they have in over a decade at the same time, which is exactly why the word keeps showing up in headlines, even though the literal transaction it describes doesn't actually exist anywhere in the paperwork. The first is the underwater trade-in, where a buyer walks into a dealership still owing more on their current car than it's worth, and the dealer quietly rolls that unpaid balance into a brand new loan the buyer often doesn't fully realize is happening until months later. The second is the voluntary or involuntary repossession, where a lender takes the car back because the payment stopped, a financial failure that can happen to a perfectly reliable car just as easily as a broken one. The third is the early rapid trade-in, a car that comes back to a lot within its first year or two, not because a court forced it, but because the owner simply couldn't live with the payment, the reliability, or both, and decided cutting their losses now beat waiting for the situation to get worse next year or the year after that. None of these 3 things get counted the same way, and none of them show up in a single official return statistic anywhere. No government agency, no trade association, nobody keeping one master spreadsheet with a single clean number on it that a journalist could simply download and report. What I'm going to show you tonight is real current data on all 3, pulled from the industry's own reporting rather than a headline somebody wrote purely to get you to click. And by the end, you'll understand exactly why 2026 has become the year this conversation finally broke into the mainstream instead of staying buried in trade publications nobody outside the industry actually reads on a Tuesday afternoon. Every figure that follows is current as of this summer, sourced from the same reports the industry itself relies on. The record year. Nobody was talking about start with a number that should genuinely stop you no matter how numb you've gotten to headlines like this one by this point in the year. The first quarter of this year saw 12.1 million vehicles recalled in the United States, the highest quarterly total ever recorded in the country's history, and the overwhelming majority of that volume traced back to electronics and software rather than anything mechanical failing outright, the way a recall used to look a generation ago. Ford alone accounted for roughly 2/3 of that total, a genuinely staggering share for one company to carry on its own, but 5 manufacturers together, Ford, Toyota, Hyundai, Chrysler, and Nissan, covered better than 90% of everything recalled, which tells you this isn't one company having a bad quarter in isolation from everyone else. It's an entire industry running the same experiment on the same underlying technology and discovering the same weakness at nearly the same time, across brands that spend billions of dollars a year trying to beat each other. That weakness has a specific shape this year, and it's worth naming because it explains why so many owners are ending up back at a dealership sooner than they planned rather than simply living with a minor annoyance and moving on with their week. Over the last 18 months, at least 7 separate manufacturers, Toyota, Lexus, Ford, Ram, Mercedes-Benz, Hyundai, and Kia, have issued recalls covering more than 1.5 million vehicles for the exact same underlying failure, digital instrument clusters that simply go blank while the car is in motion, at any speed, with 0 warning beforehand and no pattern anyone's been able to fully predict. The analog gauge cluster your parents drove never had this problem, because there was no software layer between the sensor and the needle for a bug to hide inside in the first place. A car with a screen that goes dark at highway speed doesn't always get fixed with one visit either. Owners in several of these recall campaigns have reported the exact same fault returning after the official repair, technicians unable to reproduce it on demand, which is precisely the kind of pattern that pushes a frustrated owner toward trading the car in rather than gambling on a second, third, or fourth trip to the same service department for a problem nobody can seem to pin down. J.D. Power's own 2026 dependability study backs this up from a completely different angle, using a completely different methodology entirely, and still arriving at essentially the same conclusion despite starting from a totally different set of assumptions. Owners of 3-year-old vehicles reported more problems than any previous year the study has tracked in its entire history, even as the actual engines and transmissions underneath those cars kept getting quietly more reliable generation over generation, decade after decade of steady mechanical improvement that mostly went unnoticed by the buying public. The gap is almost entirely coming from the newest features, the giant touchscreens, the driver assistance cameras, the digital dashboards, rolled out to paying customers before the software running them was fully finished being tested in-house. That's not a defect in the traditional sense of a cracked part or a worn bearing. It's an entire industry shipping features on a marketing deadline instead of an engineering timeline, and asking real owners in their own driveways to be the final round of testing nobody budgeted for, then acting surprised when a meaningful share of those same owners decide they'd rather not keep volunteering for the job. The two lines racing each other. Here's the foundation underneath everything else in this video, and without it, the rest of the numbers won't make sense no matter how many times I repeat them or how many decimal points I add to them. Every car loan in America is a race between two lines. The first line is what the car is actually worth, and it only moves in one direction, down fastest in the very first year, sometimes losing a meaningful chunk of its value before the new car smell has even faded out of the cabin. The second line is what you still owe on it, and it comes down far slower than most buyers expect, especially early in the loan when almost every payment is pure interest rather than principal, meaning you're renting the money before you're actually paying down the car itself. The industry calls the gap between those two lines negative equity. Forget the term. It just means you owe more than the car is worth, and for a growing share of new car buyers this year, that gap opened wider, faster, and stayed open longer than it has in any year on record, sometimes by a margin wide enough to make a simple trade and feel like handing over a hostage. This used to be a much smaller problem, back when the typical car loan ran 4 or 5 years instead of 6 or 7, the kind of term your own parents probably had without ever once thinking twice about it. A shorter loan pays down principal fast enough to stay ahead of depreciation almost automatically, closing the gap between those two lines before it ever has a chance to open very wide. The cars didn't suddenly start losing value faster than they used to. What changed is the loan wrapped around the car stretched longer and thinner than it's ever been stretched before in order to keep the one number most buyers actually look at, the monthly payment, small enough to seem manageable on paper regardless of what the total actually adds up to once every last payment gets counted. Run the math on an average new car this year, financed with a thin down payment over 7 years at today's interest rates, and the total interest paid over the life of that loan regularly approaches $10,000. Money that buys you nothing except permission to spread the exact same payment out thinner across more months than anyone should reasonably need, paid entirely to the lender rather than toward owning any more of the actual car. The numbers behind the record. According to Edmunds' own second quarter data for this year, nearly a quarter of all financed new vehicle purchases, 23.9%, now carry loan terms of 84 months or longer. A new record, and roughly 1 in 20 new buyers is now signing up for something even longer than that, stretching a car payment out further than most people keep the car itself. Widen it out, and 36.5% of all buyers went past 72 months, another record, up from 27.3% just a decade ago. A genuinely dramatic shift in how an entire generation of Americans finances the second largest purchase most of them will ever make in their lives, right behind a house. Down payments are shrinking at the same time, averaging just 11.6% of the purchase price, the thinnest share since the third quarter of 2020, and the average amount financed hit a record $44,156, a number that keeps climbing even as wages across most of the country have not kept pace with it. 1 in 5 finance purchases now carries a monthly payment of $1,000 or more, tying the all-time record, up from under 7% just 3 years ago, a figure that used to describe a German luxury sedan with a badge problem and now describes a fifth of the entire new vehicle market walking off dealer lots every single day. And here's where the returning conversation actually starts to connect back to real numbers, instead of a vague feeling pulled from a comment section or a single unlucky anecdote somebody happened to post online. 29.6% of all trade-ins toward a new vehicle in the second quarter carried negative equity, with the average underwater balance sitting at $6,884, a genuinely serious sum for most household budgets to absorb without a plan in place ahead of time. Buyers who roll that negative equity forward into a new loan end up paying an average of $944 a month, $167 above the market average, and are projected to pay over $16,000 in interest across the life of that new loan. Roughly $6,500 more than a typical buyer ends up paying over the exact same stretch of years. This isn't limited to cheap, fast depreciating economy cars either. Some of the highest negative equity dollar amounts this year showed up on vehicles specifically known for holding their value well, proof that the problem lives in the financing structure wrapped around the car, not in any particular badge's reputation or resale history, a distinction that gets lost the moment a scary headline flattens every vehicle into the same undifferentiated warning. The 3 ways out that all get called returning. So when a buyer hits the wall those numbers describe, there are really only 3 doors, and every one of them gets loosely called returning by somebody, whether they're describing it accurately or just reaching for the closest word that fits the feeling. Door 1 is the underwater trade, and you just heard the numbers on, walking into a new purchase already behind before the new car has lost a single dollar of its own value, starting the race between those 2 lines with the debt line already ahead. Door 2 is the voluntary surrender, calling the lender and handing the car back before anyone comes looking for it in person. It feels honorable, and in a way it is, but the mechanics are rough, and I'm not going to soften them just because the phone call itself was polite and the representative on the other end was kind about it. The car goes to a wholesale auction, sells for well under retail because the buyer needs margin to recondition it, and whatever's left after towing, storage, and auction fees gets subtracted from the balance. What remains is a deficiency, and it's still very much the owner's debt, sitting on top of a credit report hit that behaves exactly like a repossession for years afterward, whether the owner handed the keys over themselves or not. Door 3 is the one nobody chooses, the involuntary repo, and this is the door swinging hardest right now, harder than at any point in decades of tracking this exact number. Subprime auto delinquency hit 6.9% this past January, the highest level in 32 years of tracking dating all the way back to 1994, while prime borrowers with strong credit cite at roughly 0.4%, a gap of more than 10 times between the two groups. Vehicle repossessions climbed past 1.7 million last year, the most since 2009. The floor of the Great Recession, and total outstanding auto loan balances reached $1.69 trillion in the first quarter of this year, with nearly 5% of that entire pile sitting in some stage of delinquency by the end of the quarter, a share that keeps climbing with each new report. Buy here, pay here dealers, the ones who finance the car themselves instead of sending the loan to a bank, see repossession rates more than 16 times higher than traditional lenders, concentrated almost entirely among borrowers with the least room to absorb even a single missed paycheck or an unexpected car repair bill of their own landing at exactly the wrong moment. The cars carrying the heaviest share. It's worth being specific about where this actually concentrates, rather than talking about the entire market as one undifferentiated blob of anxious buyers, because the pain isn't spread evenly across every segment, every price point, or every kind of loan. Full-size trucks and 3-row SUVs, the vehicles carrying the highest average transaction prices in the entire industry, show up disproportionately in negative equity data specifically because they combine the largest loan amounts with some of the steepest first-year depreciation curves anywhere on the market, a combination that punishes even careful, well-intentioned buyers. A vehicle that costs $65,000 new has a lot more room to fall behind its own loan balance than a compact sedan financed for half that amount, simply as a matter of arithmetic. Before you even factor in how buyers of larger vehicles tend to stretch their loan terms the longest to keep that bigger payment looking manageable on paper next to everything else in the household budget. Consumer Reports' latest annual reliability survey adds a second related layer worth understanding here, because a car that breaks down repeatedly compounds the financial pressure a stretched loan already creates, turning one problem into two at the same time rather than leaving them as separate, unrelated headaches. Its most recent survey of more than 350,000 vehicles nationwide named a mainstream three-row family SUV, the kind of vehicle marketed specifically around safety and predictability rather than excitement, as the single worst performer in the entire study, carrying major problems in both its transmission and its engine at once, plus recurring electrical failures and an infotainment system prone to freezing behind the wheel at inconvenient moments. That same manufacturer has issued more than 20 separate recalls covering that one nameplate since its redesign, an extraordinary number for a single vehicle generation. And dealerships have logged nearly 2,000 additional service bulletins on top of that. Internal instructions for fixing complaints that never rose to the level of a formal recall but kept happening often enough to need a standing repair procedure anyway. When a car generating that level of ongoing frustration is also carrying one of the largest loan balances in the industry, it becomes one of the clearest examples anywhere of why the word returning keeps attaching itself to specific vehicles rather than describing the market evenly across every badge and every price point. Follow the money. None of this is an accident, and it isn't a conspiracy either, whatever a comment section might want to believe about it, mustache-twirling villains and secret meetings included. A dealership doesn't make its real money on the car itself. The margin on the metal is thin, sometimes thinner than most buyers would ever guess. The profit lives in the finance office, in the origination, in the rate markup, in the extended warranty stapled onto the contract while you're signing your name for the fourth time and not really reading page 6 anymore. There is very little money in a buyer who puts 20% down, finances 5 years, pays the car off, and drives it for another decade without ever coming back for a new loan or a new visit to that same finance office. That customer is, from a pure business standpoint, a disappointment, a transaction that generates one round of interest and nothing further for the lender holding the paper. There's a great deal of money in a buyer who stretches to 84 months, comes back underwater in 3 years, and rolls the shortfall into another 84-month contract. That customer never leaves. That customer is closer to a subscription than a sale, and once you start looking at the industry through that lens, the 84-month loan stops looking like a customer-friendly accommodation and starts looking like a retention strategy with a windshield attached to it. And the payment itself, that clean 4-digit number on the sales sheet, is designed to be the only figure most buyers ever actually look at, because it can always be massaged smaller with 3 more little words from the finance manager sitting across the desk. Just extend the term. It sounds like a favor. It rarely is one, and the industry has known that distinction for a very long time, even if most buyers standing in the finance office signing their name for the 4th time in 10 minutes have never had reason to think it through carefully enough to notice the crack. Nobody was watching. Now here's the part of this story almost nobody covered properly because it happened one level up from the driveway. In the wholesale funding machinery, most car buyers never think about and never have reason to until something like this actually happens. Last September, a subprime auto lender and used car retailer called Tricolor Holdings, running roughly 65 dealerships across 4 states, filed for Chapter 7 bankruptcy and shut down almost overnight, carrying more than 60,000 outstanding car loans. At the moment it collapsed. A company that had generated close to $1 billion in revenue in each of the 2 prior years before any of this became public knowledge. Warehouse lenders discovered what investigators are now calling a systematic fraud scheme, collateral allegedly pledged twice over to different lenders against the same loans, data irregularities buried in loan tapes and audited statements that took months to fully untangle. By December, federal prosecutors had indicted the company's founder and its chief operating officer directly and JP Morgan alone booked a $170 million loss tied to the collapse. Regional bank stocks wobbled hard in the days after, one dropping more than 13% in a single trading session because investors suddenly weren't sure how many more tricolors were sitting quietly inside other banks' loan books, undiscovered and unverified by anyone outside the company itself. Senators Elizabeth Warren and Jack Reed sent a letter to federal regulators demanding immediate action, and by February this year, Warren had opened a formal inquiry into the entire auto lending and repossession industry, writing directly to major lenders and to companies specializing in the buy here, pay here model that finances so many of the country's riskiest loans. That's the layer underneath the layer this video is actually about. It isn't just that individual buyers are underwater on their cars. It's that a meaningful slice of the machinery funding those loans in the first place was built on assumptions, and in at least one very large case, outright alleged fraud, that came apart the moment anyone looked closely enough to check, exposing a fragility most ordinary car buyers never had any reason to know existed above their own individual loan. The honest takeaway. Now, I have to be fair because that's the deal on this channel too, and the headline version of this story oversells what the underlying data actually shows if you read past the first paragraph. Negative equity share in the second quarter of this year, 29.6%, was actually down slightly from 30.9% the quarter before, and the average dollar amount owed also ticked down from the prior quarter's figure, a detail that rarely makes it into the more alarming versions of this same story circulating online. This is a serious, worsening trend on a multi-year basis, but it isn't a straight line getting worse every single month, and treating every quarter as a fresh record ignores that it occasionally moves the other way, a detail a lot of the coverage conveniently left out because it complicates an otherwise clean, alarming narrative. The tricolor collapse was driven specifically by alleged fraud at one company, not the entire auto lending industry falling apart at once under its own weight, and prime borrowers with strong credit are showing delinquency rates near 0.5%, a gap of more than 10 times versus the subprime borrowers carrying almost all of this particular pain right now. If you've got decent credit and a loan you can actually afford, none of this year's scariest headlines are really describing your situation, whatever the thumbnail implies about the market as a whole. And it's worth remembering that the loudest statistics in any story like this one are, almost by definition, describing the people having the hardest time, not the median experience of the average buyer. It's also worth saying plainly that a recall doesn't automatically mean a car is unsafe to drive today, whatever a scrolling comment section might assume about every single recall notice landing in someone's mailbox. It's often the system working exactly as designed, a problem caught and flagged before it turns into something worse, rather than a manufacturer sitting quietly on a known defect and hoping nobody notices it. Several of this year's most publicized recalls were software fixes rather than evidence of a car falling apart on the road. And Ford's own historically large recall total partly reflects a company deliberately casting a wider net and moving faster on smaller issues than it used to. A genuinely different story than an engine quietly seizing with no warning at all. Car loans also aren't leveraged into the wider financial system anywhere near as heavily as mortgages were in 2008. And unlike housing back then, vehicle values have held relatively steady rather than collapsing underneath borrowers, which makes a repeat of a full-blown financial crisis considerably less likely even as individual households genuinely struggle through it one driveway at a time, one repossession notice at a time, largely out of view of anyone not directly living through it themselves. So the fair version of this story sits in the middle, somewhere between the panic in the headline and the reassurance the industry itself would prefer you hear instead. It isn't millions of ordinary car owners walking away from perfectly fine vehicles on a whim, trading in cars they love for no reason at all. It's a specific, real, and growing number of buyers, disproportionately subprime, disproportionately stretched into loans that were never built to survive contact with real life, running into a lending system that had its own quiet cracks running through it the whole time, cracks most of them never had any way of seeing from the finance office chair while they were signing their name on the dotted line. The word returning was never quite the right word for what's happening, and I'll be honest that no single word probably captures all three of these stories at once without losing something important in the process. But it was pointing at something real, a bill for a decade of choosing the smallest possible monthly number over the true total cost, arriving at the exact same time from the driveway and from the boardroom on the same cars in the same year, whether the paperwork calls it a trade-in, a repossession, or a return. If there's one thing worth carrying out of this video and into your own next visit to a dealership, it's that the payment on the sales sheet was never actually the number that mattered most. The total always was, and it still is, no matter how many little words a finance manager uses to make it disappear from the conversation, or how comfortable that monthly number feels sitting next to everything else in your budget this month. Ask for the total before you ask about the payment, and watch how quickly the conversation slows down.